great future. We're talking real money.
The Talking Real Money podcast is back on the non-airwaves. No, we're not on the airwaves. We're on wires now. This is the Talking Real Money, talking about your money, talking about your life podcast with your host, Don McDonald here in Florida, and Thomas Charles Cock there in the lovely land of Bellevue, Washington.
Hi.
We are your guides on a trip across the confusing and complex financial frontier. For as far as the eye can see, there are pitfalls out there. You need a guide to get you through them because there are people who don't want you to get where you're going with as much money as we think you should get there with. People who actually, get this, will charge you 2% per year to provide you with a 401k plan. That is outrageous. So Tom is with us to save you, to take you
well, first of
on
all,
a trip through the prairies.
Speaking of outrage, that's an outrageous headline because it comes from a guy that is a headline writer, but there's very little substance to what he said. And I'm talking about rich dad Robert Kiyosaki. He's the one who wrote the piece that said why 401k is a horrible retirement plan. And in it, he claimed that, fees are very high. Mutual funds often take a percentage. He claims usually 2% of your investment. Well, now
he actually says usually 2%,
which is outrageous. And we'll get the numbers.
Well, there are those that charge that, though.
There are, but John Reckenthaler ran the numbers for the total cost of most people investing in 401ks, and you won't be surprised that it's about a quarter of that. It's about 0.5% a year.
Are you saying Rich Dad exaggerated?
By 3/4 or whatever percent, a lot, okay, as he always does. But let's just go back to the beaten down 401k in a general sense before we even get to the specifics. Because for most people, most of us, to have an automated, disciplined approach, money comes out of your check every 2 weeks, money gets invested. That's the best way to save for retirement, frankly, for anything, because most of us have trouble writing ourselves a check every week or every 2 weeks. It's hard. There's other things to spend money on that are more fun than putting it in a bank or in a savings account, right? So when people write your 401k is a horrible investment, and by the way, Mr. Kiyosaki would have you instead, I guess, flipping homes.
That's what I was going to say. What is his alternative?
He never says other than buy my book and you'll get rich. That's it. So, and this is one of the things I hate about people that are promoters and not practitioners, right? They're just in the business of creating headlines. That's what he does. So Reckenthaler looked into all this and dug through the actual numbers from a study called the Brightscope ICI, and I know ICI is an industry association, defined contribution plan profile, a look at 401k plans in 2020. So where they actually looked at the cost of all this. Gathered information from 60,000 401k plans representing 85% of total 401k assets. So I think that's a big measure. I think you can trust some of the numbers here, which I think will make sense to really look at, see, truly, are people paying 2% a year for the mutual funds? That's what he said, the mutual funds, right? Which is even more outrageous. But couple things to pay attention to, which you already know, hopefully. Number one, the bigger plan you're in, the bigger the plan, the lower the costs are generally, right? I mean, because they have size, they can go negotiate with people. Boeing with $200,000 in their what was formerly called VIP plan, they can negotiate a better deal for custody, for cost of funds, all that kind of thing. But even with that, fascinating. The numbers do not anywhere near describe what Mr. Kiyosaki is writing. In fact, when you look at the kind of the average of the participants in 401k plans, if you remember, bigger plans have more participants, so they get more weight in this study. It's about 0.51%. 0.51%. That is nowhere near the 2% that he claims. That is everything, by the way. That's the cost of the funds. That's the transaction fees, which generally do not exist to buy or sell mutual funds in a plan. There's other parts, Don, as you know, in a 401k plan around the reporting, all that aspect, but this includes that. That is part of the study that says you're paying about this much. Because what disturbs me about what Kiyosaki does here is what's the reaction? People think, you're right, I don't want to put money into something that's costing me 2% a year. That's outrageous. And as you point out, Dom, there are plans that charge that, but in a general sense, it's a very unfair characterization of retirement plans.
And in reality, the ones who typically charge that much are annuity products inside IRAs or 401ks, or just some of the really expensive mutual funds out there. And yes, there are mutual funds with fees and expenses at or above 2% per year. But the best way to avoid those is to avoid those. Look at the fees.
And you can do that in most. Now, 25 years ago, a lot of plans did not have index funds. A lot of plans did not have target date funds that were inexpensive. They did not exist. Today, they're there. But do you have to work a little harder to find them? Yeah. Do you have to work a little harder to build the right asset allocation? You betcha you do. Rather than just putting it all in one expensive S&P 500. But this is important. This is important work for most people. You've got to have this automated, disciplined approach. You do need to use indexes, and you got to have the right asset allocation. And this gets back to something that we have talked about on this program several times. Dave Ramsey, Susie Orman, Robert Kiyosaki, I don't know that they're bad people, but they're not in the business of actually managing money for people.
They're not bad people. They're people giving bad advice.
Yeah, but they are promoters. Remember that. Their job is to get you worked up, to go buy their book, to go buy their newsletter, to listen to their radio show, all those things. But they're not in the day-to-day business of helping you with your money. But this brings me to another part of the 401k plan, which is something that's become more popular here in the last few years, and that is custom advice in plans. Now, I do not manage my own 401k. I don't buy and sell the funds. I don't do any of that. I've got somebody else that does that, a firm that's associated with our firm that actually moves the money. The money comes in, they put it in the appropriate fund. When rebalancing needs to be, they do all that. It's custom. And now, according to Vanguard, 41% of the plans that they administer offered that sort of custom work. That's up from a third in 2018. And yet only about 10% of people use them, which can be an expensive cost too, Don. Here, the managed accounts run from 0.025, 0.25%, to 0.45, almost 0.5% of your balance each year. So if you're already paying the 0.51 or more, and then you add in the customization, now you are starting to get into the 1+ area, which can be expensive. But I think for many people, frankly, the decision here should be either it's custom or it's a target date situation, or you have to be conscious of all these things. Because if you buy 5 mutual funds and you have balance between stocks and bonds, then the money keeps going in at that rate, but the portfolio may change due to the fact that, for example, this year, the S&P 500 in the first quarter up around 10%, small companies only up 2%, right? Bonds about flat. So now you got to make a change to be back to the right percentages. Most people we know will not do that work. That's an issue.
However, there are funds that charge a fortune. And I pulled up this article from AAII just the last month, just recently, where they looked at the most expensive no-load mutual funds and the most expensive ETFs in the country. And so if any of I'm just going to give you a few of them.
Make sure you put a line through them in your 401k.
Exactly. So these are the funds. These are the mutual funds you might want to avoid. Things like the RIDEX Inverse Government Long Bond Strategy Investors Fund.
That sounds like a short bet on long government bonds.
Yeah, pretty much. Yeah. Okay, 4.3%.
No. Really?
Yes.
That's crazy.
The Midas Fund. 4.25%.
Oh, God.
Blackstone Alternative Multi-Strategy, 3.8.
Yeah,
Here's one that's interesting.
That's going to make a lot of money. You can be guaranteed of
Oh,
that.
yeah.
Right? Oh,
Here's one, and you will have heard of this one because they've pitched us on their products. And we said no. AQR, Alternative Risk Premia, 3.4%.
Wow. I don't know what that invests in.
Alternative products.
And apparently. They use leverage of some kind?
No, it's just high fees, apparently. Oh, wait, the Jacobs Small Cap Growth Investor. Now, that sounds like a good small cap fund, right?
Yeah.
Well, except for the 3.08% fees.
3.08. Okay, but let's just...
Now, wait, hold on. I got it. Wait, you ain't heard nothing yet.
We're getting warmed up.
We can go over to ETFs. You'd think they'd be cheaper because, for example, VT is 2/100ths of 1% or something,
or 3. Wow,
3,
crazy, something like that. 3/100.
The Invesco CEF Income ETF, 3.08.
That's crazy. Okay,
wait,
and you could go all day with this.
No. I got to give you the last one. Last two.
Yeah, okay.
I'm going to skip way down the list to the Van Eck.
Yeah, boy.
BDC Income ETF. You're not even going to, I want you to guess.
Well, first of all, anything with VD in the title, I got a question.
No, BDC.
BDC.
Business Development Company Income ETF.
Okay, I'll go with 4.7.
Oh, no, sir, you're so off.
I cut their fees dramatically.
11.17%.
All right, give us the last one before we talk about lessons learned.
The Simplify Bitcoin Strategy Plus ETF at 11.18. That is the most expensive managed fund in America right now.
Okay, so all right, I'll put it aside. What is the maximum anyone should pay for any mutual fund or exchange traded fund?
We used to say half. We used to say half.
We did. Yep.
With ETFs now, because generally they charge less.
Generally, not always, apparently.
Generally, I would say about 1/3% these days.
So 0.3, 0.35,
maybe, yeah.
Okay, all right. Yeah. No more.
No more. You don't need to pay more. Yeah, the only area where you might pay slightly more than that is when you're dealing with a factor fund that is really tiny, like micro cap strategy.
It's harder to manage, harder to buy.
Emerging markets micro cap or something. That's going to get a little bit more expensive, but
really
not
small, risky,
not 11% expensive
in dangerous countries. Sure, that makes good sense. Sign me up for that. All right, that's fair. But back to the 401k.
Yes.
Ignore the headline. Invest in your 401k. Keep investing in it. Ignore the nonsense. Man, there's plenty of it out
pay
there.
Attention.
This is real nonsense.
Ask what the expenses are.
That's fair. Yep.
You should. You need to know. Most people don't know that. Ask the question.
I think that's excellent. All right. A couple of questions here. We've been getting a lot of questions. And thank you for them.
Well, it's because the podcast is growing like a weed.
It's good. Here's an interesting one. We've touched on this before, but we'll do it again. This, I don't have a name on it, but they just forwarded the question to me. Fidelity, they wrote, has been heavily promoting direct indexing through them to optimize my returns by minimizing my taxes. They're proposing investing in around 250 large cap stocks, which would be managed by them, including tax loss harvesting. What are your thoughts about this and direct indexing in general? I don't think I've heard this topic recently. We have touched on this in the past.
Yeah,
you and I have a difference of opinion here. Slightly.
Well, not a big, it's not a big difference of opinion. The only real benefit that I see to direct indexing is the ability to better manage your tax loss harvesting strategy. That is the real benefit.
There's one other. Let's assume, for example, that you are an employee of a major tech firm and you have a huge holding in one particular
the fact
security.
That you can swap in.
You can get rid of that holding.
Okay, let me broaden it. The only advantage is from a tax planning.
That's correct. That's right. And that's what it
Otherwise, in terms of returns, it shouldn't be better.
No, it shouldn't be sold that way either, by the way. They shouldn't be selling it on, we're going to make you more money. I hope they're not, because I think that's disingenuous.
In fact, I think it may make less because it's a more expensive strategy.
It may well do that. Yeah. And the idea here is, and this is for very few people. This is what worries me. People are, I got to have that because the rich people are doing that. No, you don't have to have this. Part B, you have to be in a tax situation that is where this is going to be helpful. In other words, generally, you sold something and now you have a big capital gain. You have these stocks you can now sell because out of the 250, some will be losers, right? You could be Tesla down a third since the beginning of the year. You dump in your Tesla stock, right? And you're, offsetting that against the gain. That's the situation. Or you're booking losses for future years. But that's it. I don't think beyond that, you're correct on that you should be buying it as a performance aid. I don't think that's what's going to happen with this.
Yeah. So it's the reason we don't talk about it more is because it's a very specialized tool that we try to stay with things that are applicable to the largest percentage of our audience.
That's right.
And we have covered them and we will again, but it's not going to be something we suggest regularly because of its higher level of complexity. It is bound to be a more expensive way to invest. It almost has to be. So those expenses need to be offset by the tax savings of the portfolio.
Yeah, and to that end, by the way, what you struck the chord exactly right. Yesterday, we got complimented by a CFA. And remind me, CFA, that is
Chartered Financial Analyst.
Thank you. Used to host their dinner here in Seattle many years ago, who called our advice pragmatic. That's what we're trying to offer on this. It's pragmatic advice. It's straightforward. It's easy to implement. And direct indexing is for a very few. All right, another question. This one comes from Bountiful, Utah, where they must have a lot, I guess, right? Because it's Bountiful, Utah.
Yeah.
Just guessing.
Much.
Tyler writes us. First of all, apparently we sent Tyler Talking Real Money t-shirt in the mail, said thank you. I wear it all the time, but unfortunately my wife also loves it. It's comfortable. Rest assured between the two of us, getting plenty of wear, getting your name out there. Do you share a lot of clothes with your wife? I don't really think.
None whatsoever. None. Not a thing.
No. Maybe that's not something we want to put on the podcast that you're sharing.
No, we just, clothes. She looks great in a dress. I don't.
I'm curious that.
I don't know actually that I do or not.
I
could look smashing in a dress.
Somewhere along the line, you would have been, like that.
You're right. I did it once for a fundraiser for a theater group where I dressed in drag. But
is that on your Insta account somewhere that I can find?
That was when I was much prettier.
Okay. Many years ago. All right. Second.
Much prettier. Like 30 years prettier.
You got to shave those legs a little closer. Second, I was surprised and delighted you sent me Don's book. I read it, enjoyed it. Given how great Don's voice is, I think it would have been better as an audible book to listen to. Isn't it available?
No, I've never done it.
Done that. Okay.
I have never actually I recorded Paul Merriman's book.
Yes, you did. And he complimented you for that retirement.
And I have, by the way, one of the reasons I haven't done it is because I tried doing it as part of my voice work. And it is I forgot how much I didn't enjoy doing Paul's book.
Not easy,
and then I went to do someone else's, and it is, for me, recording an audiobook is the most tedious, boring, frustrating process of anything. And I love to talk, speaking of my voice.
Yeah, you get that idea. All right, here's the question. Thank you, Tyler, for your compliments. I recently received an email from Vanguard asking if I would like to participate in their, quote, fully paid lending program. I'm not familiar with this concept and would love to know your opinions on it. Where you're lending your securities, I assume they're talking about.
Yeah, I'm sorry. I drew a blank and I went, okay.
They're going to give money? No, not like that. No, lending as in lending your securities out.
It's actually a pretty safe thing to do.
I don't think there's a whole lot of risk to it.
There's very, very little downside to it because they've got they have a lot of collateral.
Yeah, turns out.
A lot of collateral, and it can make you a little extra money. You kind of just split it with the brokerage firm.
Explain what the deal is, though, what they're doing with the stock.
Well, they're lending the stock to people who want to sell the stock that they don't own, so they can bet against the rising price. They're betting a security will go down in value. If they're wrong, they have to buy the stock back at the higher price and pay you back. These are clients that are relatively well vetted, and they put up over 50% of the value of the stock. You're not out there at 100%. And then the firms back you up on top of that.
That's a great question. By the way, I mentioned Retire Meet briefly. That's available online. Go to talkingrealmoney.com. You can click on Retire Meet 10 and watch it anytime. I already had a lot of views. I think it's one of our more viewed videos in all the videos we've done in 10 years. So you're welcome to watch it anytime. I think you enjoy it. We got a lot of great comments from it. So, and if you want a little more help, man, I've been talking to a lot of people. Spring cleaning is there. Getting rid of the hodgepodge, Don. A lot of people have called. A lot of people have written in. You can go to talkingrealmoney.com, click on Meet an Advisor, and you'll do exactly that.
You'll meet an advisor.
Yeah.
Free. Free. I mean, like no charge. Seriously. And we've been doing this for, I don't know, over a decade. And so far, no one has complained.
No, actually, I think that's true. I don't think anyone ever actually has said, well, that I didn't get what I thought out of it.
Yeah.
So, no, good point. So
all
take
right.
advantage of all those things.
That.
We want you to be a better investor.
Yeah. That's why we do this. Really, truly, that's why we do this. We want you to end up with more of, this is the important part, more of your money. And the other people who help you with it, sure, they deserve to be paid, but not as much as they've been used to getting. I mean, remember, even fee-only advisors used to get, a few still do, 2.5%, even 3% per year.
You go read ADVs and find that there's still people are still charging.
There's still some out there charging that. That's nuts. Too much. And commissions, 5.75%. No one deserves that. Commissions on these annuities that are hidden from view. No one deserves that. You want some pragmatic advice? Well, tell your friends to listen to Talking Real Money too. Tell your enemies, whatever. We don't care. The more, the merrier. And thank you so much for being a part of our podcast. And remember, we do one almost every day. Although in the summer, we may go to a 4 podcast a week schedule.
Like the rest of America?
Yeah. Only going to come into the office 4 days a week. I'm Don. Tom's over there. And we love to be hanging out with you, talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.